Stocks are in the red this morning after the latest GDP print showed a sharp slowdown in economic growth and also pointed to persistent inflation. Dashing investor hopes that rate cuts could be coming anytime soon. Inflation worries also sending the yields on the 10-year Treasury above 4.7%, the highest level that we had seen since the start of the year. For more on this, we want to bring in Jason Furman, the former chair of the Council of Economic Advisors under President Obama. Jason, it's great to have you here on Yahoo Finance. Thanks so much for taking the time to join us. Let's talk about that print that we got out this morning, because I think when a lot of people are taking a look at that GDP report, they're taking a look at that headline number, asking themselves a little bit worried about the fact that maybe we are looking at an economy that's considerably weaker than we initially thought. Is that the right take? Or if you look underneath the surface, is there reason, though, to believe that this print actually isn't as bad as that headline number suggests?
Yeah, I think there was very little to be worried about in terms of real GDP and real growth in this print. There was a lot to be worried about in terms of inflation. On the first, most of that miss was volatile stuff. You had inventories subtracting almost half a point from growth. You had net exports subtracting even more from growth. Those are not factors I would expect to persist going forward. If you look at something more like core real GDP growth, consumption and fixed investment, that was up 3.1% annual rate in the first quarter. That's really quite healthy real GDP growth.
Jason, let's talk about maybe the worrisome side of this when it comes to inflation, the pricing pressure, and sticky inflation prices that we are seeing. What do you think this signals just in terms of how much more work the Fed maybe still needs to do before we can even talk about lowering rates?
Yeah, the big surprise here was that at an annual rate in the first quarter, core PCE inflation, which is basically what the Fed is looking at, was a 3.7% annual rate. As recently as 2 months ago, that was expected to be 2.1. Forecasters thought mission accomplished. Instead, we now have a red flashing warning sign. The Fed will not be able to be reassured enough about inflation to cut rates anytime this year, maybe in December, probably not. The only thing that's going to get us Fed rate cuts anytime soon is a much more rapid deterioration in the job market than I expect to get or hope to get, but that's the contingency under which the Fed cuts rates before December.
So, Jason, what do you think, looking out beyond December into 2025, what that rate cut picture potentially looks like then for the Fed?
Look, I think we're in a world where the neutral interest rate is almost certainly higher than what we thought a couple of years ago, but we have no clue, no idea how much higher it is. My guess is the Fed is probably, absent a recession, not able to lower rates much below 4.5, that there aren't that many cuts there absent a recession. But, look over a long enough time horizon and eventually a recession, the cumulative probability of a recession becomes near certainty. So at some point they're going to respond, but I do think that's not going to be because they're reassured about a soft landing. That's going to be because they're worried about a recession. And right now, there's nothing in today's data to increase your recession worries very much, if at all.
And Jason, when you take a look at a number like we got today, or taking a look at the recent trend that we've seen in inflation, the fact that we haven't seen improvement, we've actually been trending to the upside. There has been a bit more talk in recent weeks about maybe the Fed could actually end up hiking one more time. Is it at all in play? Is that at all under consideration for you?
I hope it is for the Fed. It should be. Right now, financial conditions have tightened all on their own. So we've had the equivalent, basically, of one Fed rate hike over the last month, maybe 1.5 after today's data. So the market does that on its own. I think if inflation is, persisting into the second quarter at a rate above 3%, absolutely they should be very seriously considering more hikes.
Jason Furman, always great to talk to you. We hope to have you back here on Yahoo Finance again soon. Former chair of the Council of Economic Advisors under President Obama. Thanks so much.
Thanks for having me.